There's a saying, when there's blood in the streets, buy property. And it's never been truer than right now. I get asked over and over again, is it a good time to buy property? And we just want to explore that a little bit. I did a video on Facebook Live just before South Africa went into lockdown in March. I remember Josephine, who's with me, came on live, and she interacted with me a little bit there. And we want to talk a bit more about that today.
Yeah. Thank you for having me with you today.
Oh, before we go on, I just want to introduce ourselves in case you don't know me. I'm Vorster from Organic Growth, and this is Josephine van Wyk. She's my eldest daughter, and she's in property as well. She's also an artist, but today we're talking property.
Yes.
So Joe, thanks for joining me.
My pleasure. Thanks for having me.
And Joe's going to ask some of the questions that we're being asked.
So back in March, you kind of touched on two things that really stood out to me. One of them being a prediction that the interest rates would drop, and drop they certainly have done. And also a bit of a suggestion that there would be lots of movement in the market, lots of tenants changing spaces and needing bigger places or spaces better suited to their new circumstances. So I thought it might be quite helpful to maybe address the first one, at least, in terms of the interest rates.
Okay.
Yes.
From the interest rate point of view, yes, it's actually worth doing an exercise. I've done an exercise, which I'll show you now. But in January, we started out this year with the prime interest rate was in South Africa was 10.25%. It's now just dropped to 7%. Now, it might not seem a lot, from 10.25 down to 7, but it makes a dramatic difference to your bond repayments.
Yes.
So, for example, if you had in fact, let me go to an example. I've got a spreadsheet here. In this example, we're using a 700,000 Rand bond over 30 years. And as you can see in the pink, January 2020, at the beginning of this year, the prime interest rate was 10.25%. And that resulted in a bond repayment of 6,273 Rand per month over the 30-year term. And if you look in the green blocks on the right, August 2020, the prime interest rate is down to 7%, resulting in a bond repayment of 4,657. That's 1,600 Rand difference between January and now. And when you go and plug that into a monthly spreadsheet, as you look at the actual cash flows, you see in this example, we're using a rental income of 7,000 Rand a month. The bond repayment look at the January section. The bond repayment is 6,273. The levies are 1,383, and the rates 304, resulting in a monthly cost of 7,960. And if you take that 7,960 as your cost and you deduct that from the rental income, you see you have a shortfall of 960 Rand. So in January this year, this property would have shown a shortfall of 960 Rand. Now you go to zoom forward to current day, and you see the same rental income. The bond repayment is now reduced to 4,657, and the result is your monthly expenses are down to 6,344, resulting in a positive 656 Rand. So in other words, instead of having to live with a shortfall of 960 Rand a month in January, in August you're sitting with a profit of 656 Rand. So each month you cash flow positive to the tune of 657. So you can see from this little cash flow exercise I've done that you move from a cash flow negative monthly to a cash flow positive monthly. And in other words, a property that you were expecting to make a bit of a loss on it initially, in other words, that's your normal investment period, you now go straight into profit. So actually you've got a bit of a tax problem.
Yeah, I was about to say that must lead to other difficulties.
So it's a weird thing. You buy property and you get 100% bond finance, and you think, okay, I've just invested a whole lot of money and I'm already making profit on it. Wherever I invest, where's the money I've invested?
Yes.
So it's a bit of a weird thing. You're expecting, we expect to have a shortfall for a couple of years, and now it's actually the other way around. But I do want to show you an example. One of the properties we sold to one of our investors in January. Now, at the time, we did the numbers based on an interest rate of 10.25%. And this investor is having the property managed completely remotely. In other words, it's going to be a passive investment. So the agency fees for property management and for the leasing into the picture. So when you do that, you find that she was expecting a shortfall of 2,000 Rand a month from day one in the first year, and the second year obviously that would reduce, and eventually it'll go cash flow positive. In her situation, the transfer was delayed by the lockdown and COVID.
So useful.
So she's just taken transfer, and her cash flow expectations now are I think it's about 350, 300 Rand a month shortfall.
That's a phenomenal difference
phenomenal.
From 2,000 to 300 Rand.
So she was budgeting on a 2,000 Rand a month, and now it's only 300 Rand a month. She's probably saying, well, why didn't I buy 3?
Yeah, absolutely.
Okay. So from that point of view, that you can see just interest rate alone, it's time to buy property. You know, the interest rates are the lowest they've been since 1998, when they introduced this new repo rate system where the repo rate governs the interest rates and so forth. And it hasn't been lower since then.
So I have a question then off the back of that, because I think it makes sense to go, it's fantastic right now, but what are we looking at here? Because what goes up must come down. So does what goes down have to come up
Absolutely.
as well?
Yeah. You know, if your interest rate's at its lowest, the question is it going to go down lower? And when is it going to come up? That's really what the question we had. So I personally think that the interest rate's going to go lower still. I think another 0.25% is quite entirely reasonable. I'm not alone in this thinking. You know, you look out there and some of the economists are thinking this. And to get an understanding what's happening is the government is trying to stimulate the economy by reducing the interest rate. What that does is, as they reduce the interest rate, it's cheaper to borrow money. So you'll borrow more. I mean, you've just looked at this example in a townhouse. Instead of buying one, you could buy 2.
Yes, absolutely.
Or you can buy that car, a more expensive car now, because the payments are the same. So everything becomes more affordable from an interest rate point of view. That's what stimulates borrowing, which stimulates the economy, gets the cash flowing again, because we've all been in lockdown and saving our money and doing all kinds of things. Incidentally, if you've got money in savings, you're crying right now because your returns are so low.
Yes.
You can see why Robert Kiyosaki says savers are losers. You know?
Yeah,
So
absolutely.
it's only when you get into these crisis times when everything shakes, you start seeing, so this is what Robert Kiyosaki said. And so this is what he said. This is what happens. So what we've got to try and do now is we've got to say, where are we in the market? Is it time to buy or is it time to sell? And I think it's absolutely time to buy, because the interest rates are low now. And the question you asked about what's going to happen, how long is it going to stay low? So I think it's personally going to come down a little bit more, because they really need to get this economy going again. And then the force that pushes the interest rates up again is inflation. So yes, we are going into inflation. I don't know when, but it's certainly coming, because the government's been pumping money into the economy, but the production's less, so you've got more money, less products, so of course those products are going to cost more. So it will come up. So inflation will come up, but as buy-to-let investors, we're not worried about inflation. And I'm sure I'll discuss that in another video.
Yeah, that sounds like a story.
Make a note of it, Joe. Let's talk about it.
Yes.
But inflation's good for us buy-to-let investors. So what I think is going to happen is as we come out of this lockdown and as the economy kickstarts again, the interest rates will go up. But they'll have to go up slowly, because if they go up too fast, it freezes the economy and then we end up reversing all the good that they've done. You know, so what's going to happen is the interest rates will come up, but it'll come up in a controlled fashion. I certainly don't see it going up as quickly as it's come down. I mean, we've come down 3.5% in 6 months, 7 months.
Because if the opposite were to happen, then that investor who's now only 350 Rand in the negative and is suddenly having to pay 2,000 Rand is going to be quite uncomfortable.
Yes. Yeah, of course. So the thing is, be a little bit careful. All right, budget for it to go up, but not extremely. But the nice thing about it, if it goes up gradually, it's come down by 3.5% in 8 months. It'll probably take 3-4 years to get back up to this level, if not 5 years. And in that time, you've got rental escalations. And then another dynamic that I've seen in property is it's so exciting to watch. It's almost like the whole system was designed around the property owner, because what happens is the rentals are there. The interest rates have dropped, so your monthly cash flow, your costs have dropped significantly now if you've got an existing bond. Okay, so this has dropped, but your rentals haven't dropped because the rentals aren't tied to an interest rate.
They're tied to a lease agreement.
They're tied to a lease agreement. And not many leases, when you renew them to the interest rate, does the rental drop.
Yeah.
Okay, it doesn't really happen. So the rentals will plateau a little bit, and if not go up a little bit in the new year, but we're seeing them plateauing at the moment. But
If anything, they might be slightly lower at the moment.
Slightly, but it's a slight compared to the interest.
Yeah,
it's
like
a massive
200
drop.
rand.
Yeah.
It's not
200 rand on 6,000 rand compared to a 2,000 rand drop here. So what's going to happen now is as the interest rate comes up, and I saw this happen 10, 15 years ago when the interest rate moved. What happens when the interest rate goes up? There's a general consensus among everybody that things are costing more. Every landlord is feeling the pain, so there's pressure to push up rentals. And when you're a tenant signing a lease and the landlord says the interest rate's just gone up, my costs are more, it justifies the increase in rental. So what will happen is the interest rates go up further. And it's not the interest rates, the rentals go up. But added to that, any potential owner who's now, in other words, the guys who are in the rental market, there's a whole market of people who are renting. That market that shrinks as people decide now rather buy than rent. So when they're making that decision, the interest rates going up makes them say, hang on, I'm scared. I'm not going to buy now because what are the interest rates going to do? So I'll rent instead. And I'll pay a little bit higher rental. So those two forces cause the rentals to go up with it. So you see, at the moment, what we've done is that's the rental, and this is your bond repayment. The bond repayment's dropped, and in future, what's going to happen is as this comes up, they go up together. So it's kind of a ratchet effect, and I've seen it happen over and over again. So as an investor, it's really comforting to know that there will be time.
Absolutely, because I think that would be my chief concern is, how much respite do we have and how long will it last for?
Okay, what is the other one you wanted to talk about, Joe? The movement changes?
Yes, so just in terms of tenants who have now been working from home for not far from 6 months in some cases, you said that, a lot of people who previously were comfortable in a 2-bedroom, for myself and my husband, we're in a 2-bedroom place. And then both of us working from home during lockdown, I'm at a dining room table with piles of things all over the place. It's just not a sustainable long-term solution. So I was just interested to hear your thoughts in terms of tenant movement and how much movement to anticipate and kind of the timing of that.
Okay.
But that might be a can of worms.
Yes, no, that's a big subject. And in fact, I want to do another video on that subject alone, but let's just touch on it now.
Okay.
What we're seeing in the rental market, as we came out of the hard lockdown in sort of May, June, we had a lot of vacancies in our portfolio. I can only really speak with authority on our portfolio, which is a Johannesburg portfolio.
How many units?
About 220 odd units as a pool we're looking at.
It's a good sample size.
Yeah, it's a nice sample size, and they're all the same sort of. They're ranging from the sort of the 500 to the 1 million rand townhouse. That's kind of the segment we're looking at. We saw quite a lot of vacancies. We saw vacancies increase in June, as there was a little bit of shock and horror in the market. People lost jobs and so on, so they moved home. And so the vacancies, and it was very difficult for agents to replace the tenants. Even if you wanted to move, you couldn't. You were locked down.
Yeah.
And I did a couple of videos on what we can now move. It's all very exciting. I mean, can you believe a market where we're actually excited that you can move again?
Yeah.
We're so used to these freedoms.
Yeah.
So since then, I've seen the vacancies come back down again to almost normal pre-COVID times. It's almost
That's
there.
amazing.
In 2 months, we're already back there.
Sure.
I've seen the rentals pretty much plateau.
Okay.
Most landlords have been quite reasonable. Said no, if I just retain my tenant, I'm happy. So we've seen that thing where the rentals have stayed sort of the same. Your money in your pocket is a lot higher because of the change.
Of course, if your interest rate has changed and you're still getting the same income from a tenant.
So what I'm seeing now is that those people who are really uncomfortable, they're starting to make the decisions of, like you said, you working. If you have to work from home, you're working at a desk.
Yes.
You're working on you're not working at a desk. You're working at your dining room table.
Yeah.
And your husband's working on a desk in the spare room. So if we're seeing business changing. A lot of businesses out there, I really don't want to be in a commercial property space right now. I'm so glad I'm not. But if you're in commercial property space, you're sitting with massive vacancies. As more and more companies are realizing, hang on, my staff can all work from home. I can take my rental bill down by half or 3/4 even.
Yeah.
Or cut it out completely and have the whole, everyone work from a virtual environment. We're seeing a lot of that. But what that means is that more people are working from home, in other words, more demand for home. So I'm seeing the demand for home rentals and townhouse rentals starting to increase now. And with that will come the price increase. So we're into a good time. You know, people who don't buy this year, 2020, are going to look back in 2025, 26, they're going to say, why did we not buy in 2020? You know,
yeah, hindsight is 2020.
So the object of this video is to try and just say, look, I've been around in this space for quite a long time. I've seen some of the cycles, and I can say without too much doubt at all that despite the economic effects of this virus and the pandemic and so forth, it's a really, really good time to buy investment property.
Sure, that's great to know. Thank you for sharing that advice. Sure.
And look out for our next video. We're going to look into this accommodation, the movement. I think we need to address that. Joe, will you come back again?
Yeah,
let's talk about it some more.
Yeah.
And if you want to make sure that you to get that video, you see that video, please subscribe below, and that way you'll be notified when we upload our next video.
Wonderful.
Thank you.
Great. Thank you.